Well, good evening and welcome to this live session on the economic outlook for India, powered by Investonomics, an initiative by ICICI Securities. We are living in a very turbulent times. A weakening world economy is putting pressure on industrial commodity prices. The sharp rise for commodities in March led to record inflation the world over in April and May. But the recent decline in metal and oil prices suggests inflation may have peaked out for now. Is the worst inflation behind us? Is this a bad news that cooling of inflation is being caused by a recession? Is the reversal in commodity prices temporary or here to stay? To have an insight on how the economies could unfold and shape up going forward, joining me now is Mr. P.K. Basu, Chief Economist at ICICI Securities. Welcome, Mr. Basu.
Thank you, Gitu.
Mr. Basu, some of the key questions everyone is trying to find answers for. Has the inflation peaked out? Is the rally in crude prices over? Will central bankers, turn less hawkish as time passes by? Are recessionary fears for real? So, what are your answers to all these queries?
That's a lot of questions, Gitu. Let's start with inflation. Is the worst of inflation behind us? Well, globally, I don't think so. Globally, we probably still have a few more months of really high prices and high inflation in the US, EU, UK, etc., because they were very slow to pull back from the aggressive monetary expansion. And so inflation is here to stay and will be very high for some time. The good news, though, is that the Fed has grasped the nettle and is aggressively tightening monetary policy. It is almost certain that the next rate hike at the end of July, at the end of this month, will be 100 basis points. And that will go some way towards bringing normalcy back. I think thereafter there'll be another significant hike in September.
Okay.
And I think the rate will get to 3%. By September. Once we have the Fed funds rate at 3%, I think then most of the tightening is done. Now, with regard to inflation, for India, we may have already seen the worst. The worst was probably 2 months ago. The latest data point, inflation was 7.01%. So there's been an easing off a little bit in the last 2 months, and it'll continue to ease going forward somewhat more. Partly because of oil prices, as you said, oil and metal prices have come off. But in India, inflation is now more broad-based as well. Inflation has become much more broad-based. Food inflation is high, and in particular, vegetable inflation is around 17%. So we have a more broad-based problem of inflation at the moment, not just in India, but around the world. As I keep emphasizing, India's M2, broad money growth, during the COVID period was much more moderate than in the West, in the US in particular. So we had M3 growth of just about 11% on average during the 2 years from April 2020 to March 2022, and that means that India's inflation is not as far out of line with the past as it is in the US. Now, remember that the US has a 2% inflation target. The core PCE inflation rate is still 4.7%. Headline inflation is 8.5% for CPI. So it's way above their target. Now, India's target range is 2 to 6%. We are still above that. So I think that the RBI has to raise rates further. I expect that India's repo rate will get to 5.5% by the October MPC meeting.
Okay.
But that is not as drastic an increase as is occurring in the US. In the US, of course, they're going from below 0.25%, from 0 to 0.25% to start with. They've already done 150 basis points of hikes from that point, and another close to 150 basis points will occur over the next couple of meetings. So that's a very, very steep hike. Now, what that is doing to the US is that it is causing the US to slow down. We saw the first signs of that slowdown in the ISM manufacturing data, PMI, and particularly the new orders. The new orders are a leading indicator about 6 months ahead. And ISM manufacturing new orders in the US were below 50 in the latest reading. So if it's below 50, that's a sign of contraction ahead. So we already have the first evidence of the slowdown to come. Even bigger evidence really is the inversion of the yield curve. The yield curve, the 10-year minus 2-year yield curve, whenever that inverts, you get a recession within 24 months. And it has happened every single time since the Second World War. So we can be sure that the US is going into recession by March 2024. Because the first inversion occurred on the 1st of April, 2022. So 2 years from there, you're going to get a recession. So unfortunately, a recession is almost baked, I wouldn't say almost, it is baked into the cake in the US. Now, will the recession be severe? Perhaps not. It'll probably be a fairly brief recession. And one of the reasons it'll be brief in the US is that interest rates would have risen perhaps to 3.75%, even perhaps 4%, before inflation begins to moderate enough for the Fed to cease its rate hikes. That, coupled with the fact that there hasn't been a massive re-leveraging. People haven't taken on floating rate mortgages at much lower rates, etc. So since there hasn't been a massive re-leveraging in the US economy, the next recession would probably be mild, especially because there'll be a lot of room to cut rates, perhaps from 4% to 2%, which is a significant moderation, but it's not going to go down to zero. And so we get a more normal rate cycle, and the economy returns to some normalcy. Now, so that's the US. In terms of the Eurozone, things are much worse. The Eurozone didn't really have that much of a strong recovery in the first place. Inflation is extremely high. The ECB is supposed to target 2% headline inflation, not core. Unlike the US, where the target is core inflation and core PCE inflation, here it is headline CPI inflation, and that is 9%. So you have CPI inflation of 9%. So naturally, yesterday, the ECB was forced to raise rates. Remember, in March, just 3 months ago, 4 months ago, the ECB said at its policy council meeting that they would be continuing quantitative easing until October, and then tapering, then slowing down the amount of quantitative easing they're doing. Instead, 4 months later, they've been forced to raise rates. Of course, quantitative easing is gone. It cannot continue. So the impact on Europe is very negative. What it does is that, first of all, sovereign spreads for Italy, Greece, etc., have gone up sharply. And we've also got a problem with Germany. I mean, Germany, for instance, depends so much on Russia for its oil and gas needs that now they've had to cool the economy down quite sharply. And last month, Germany reported a decline in exports, which is a rarity. It hasn't happened much in the last 30 years. So even Germany is slowing down as a consequence of the rather aggressive stance that they've taken. It's quite ironic that when the war started, when Putin started his so-called special operation against Ukraine, there were lots of rumors and news stories about a coup against Putin, etc. Instead of Putin falling from power, Boris Johnson has, and now Mario Draghi. So UK and Italy have already lost their prime ministers, and Putin continues to stand. So, if anything, the West Europe is getting weaker because of its very aggressive stand against Russia. But unfortunately for Western Europe, Russia has many more cards. The biggest card is denying access to gas. Now, I don't think it is in Russia's interest to deny Western Europe access to gas. So they held out the warning for about 10 days, and then they opened Nord Stream 2 because Russia also desperately needs the revenues. So I don't think that we are going to get, the Europeans had initially said that by mid-year, that is 22 days ago, they were going to ban all imports of oil and gas from Russia. That day has come and gone, and now they're saying end of this year. In a little while, they'll probably say middle of next year. So the point is that it's not possible to completely ban imports of oil and gas. So better sense is gradually prevailing. But in the meanwhile, we have a bad situation in oil markets and so on around the world. It's also worth noting that most of the wheat growing area of Ukraine, it has now basically fallen to Russia. So Russia was already the largest exporter of wheat in the world. It has gained most of the wheat fields of the fifth largest exporter as well. So in terms of grain, in terms of wheat in particular, Russia will soon have a stranglehold on world supplies of wheat. So the war isn't going well for Russia. It's making very slow progress. But more or less, Russia is gaining most of the ground that it needs. And the only trouble for the rest of the world is that the war isn't about to end. I see it in another 4 or 5 months of slow conflict.
So that seems that worst is still not over. We have to be a little cautious as far as the world economies are concerned. So what is the kind of impact that you see of stagflation on emerging and developing economies, including countries like India?
So stagflation is primarily happening in Europe. The US has high inflation, but it does not have stagnation. It has an economy that is still very strong, but likely to head towards recession by the end of next year. By the time recession comes to the US, inflation will be much more under control. So it will not be stagflation. It'll just be a normal cyclical downturn with moderating inflation and low growth, and in fact, a brief contraction for two quarters. Stagflation is basically hitting Europe at the moment. And for India, that isn't good news because the US and Europe are important export markets for India. Right. But what is interesting is that so far, India's exports have held up very well. In the calendar year to date, India's exports are up nearly 24% year on year. And that is on top of a spectacular year last year. Last year, India's exports for the full year were up 41.6%. So we're continuing a second year of good growth. So that is indicative of the fact that India has, there's been relatively low investment spending by the private sector in India. But the investment has apparently, quite clearly, in fact, been focused on export-oriented sectors. And the export sectors are seeing good productivity performance and gaining market share. India is gaining global market share in the last year and a half because there's been a lot of investment in those areas. Now, the other thing is that the domestic market hasn't recovered quickly enough. So you see this, for instance, with steel and cars. Those are two areas where India's exports are doing very well. Domestic demand hasn't really picked up, especially for cars. Now, last month was a very good month for cars. So we're beginning to see a gradual shift from an export-led economy to a more, a better, broader-based economic recovery in India. And I think that in the second half of the fiscal year, most of the growth in India will come from fixed investment spending, and gradually it'll spread to consumption as well. Mm-hmm. For now, of course, most of India's growth is export-led.
Mm-hmm. With Mr. Basu, with rupee sinking to new lows, recently RBI announced steps towards internationalization of the rupee. What do you think will be the long-term implications of this move, and where do you see rupee in, say, next 6 months to 1 year time?
So, first of all, with regard to the rupee, it's not the only currency depreciating against the dollar. Mm-hmm. The rupee is actually appreciated against the euro, the pound sterling, and especially the Japanese yen. It has more or less held its own against Chinese renminbi. So, in fact, in the last month and a half, the rupee has outperformed the renminbi. So basically what we have is the rupee depreciating alongside other global currencies, which are all depreciating against the US dollar. So my view on the dollar is that the dollar will continue to strengthen between now and September as the Fed keeps tightening aggressively. Mm-hmm. But once the Fed funds rate gets to 3%, then most of the really rapid rate hikes in the US will have been completed. And then thereafter, I'd expect that the dollar index will begin to lose some momentum. Will lose momentum and, in fact, will begin to depreciate. Mm-hmm. Just a minute. Can you still see me?
Yeah, I can see you.
Okay. So that is the situation, and so I expect that by September, the rupee will be about 81 rupees to the dollar.
Okay.
And it's just that we are not living in an island. We are in a globally connected world. Right. And in this globally connected world, where every currency is depreciating against the dollar, it makes no sense for India to stand like King Canute trying to push the waves back. Mm-hmm. That's not possible. What will have to happen is that we will see further depreciation between now and September. Okay. But once, I expect that in the second half of the year, oil prices will come off, partly because global demand will come off for oil. Global demand will weaken as the US and European economies slow down. Mm-hmm. So the likely impact of all this will be that between September, the peak for dollar against the rupee of 81, from there, I expect that the rupee will rebound somewhat and get to 79 by March. Mm-hmm. And then, it doesn't need to keep strengthening. I think that, 79.80 will be the range in the subsequent fiscal year. Now, it could, of course, under normal circumstances, it could appreciate a lot more, but I don't think the RBI will want to see the rupee appreciating too much. Now, so that's one aspect. Now, the other, the internationalization of the rupee, that is an interesting step. What it has done is basically it has taken, it's basically allowing exporters and importers to invoice more of their trading in rupees. And that is a significant step towards the internationalization of the rupee and eventually towards full convertibility of the rupee. Remember that the renminbi, the Chinese currency, is not yet a convertible currency, but it has internationalized. China has been encouraging some of its trading partners to invoice in renminbi. But ultimately, if a country's currency is to be properly internationalized, it it has to become convertible. And I think for India, this is a step towards convertibility. Now, for convertibility to be sustainable, what you really need, very importantly, is that you need to have some rules around the fiscal deficit so that the FRBM type of act from 2002, 2003 needs to become properly legislated and needs to become ironclad, so that there isn't a profligate government that can really put the rupee under severe pressure. So I think that moving in that direction will require some other steps as well. Now, in the meanwhile, the fact that there'll be more invoicing of imports and exports in rupees is a positive, and it also means that some central banks, including our neighboring countries' central banks, such as the Sri Lankans, the Bangladeshis, Nepal, should be encouraged to hold more of their foreign exchange reserves in rupees. And it makes abundant sense for them to do it, given the amount of trade that they do with India. They all export and import quite a lot. They all actually import a lot from India. So it makes a lot of sense for them to use the rupee as a reserve currency. And that is an important step also towards internationalization. And I think the Russians will not be averse to doing that either. So we'll see a gradual move towards internationalization, towards the use of the rupee as a reserve currency. But ultimately, for that to become an ongoing thing, then what needs to happen is that India will need to move towards a convertible currency.
So there are concerns about the re-emergence of the twin deficit problem for Indian economy, that is due to the higher commodity prices and rising subsidy burden. And we all understand that the government will have to do a tough balancing act between maintaining growth and macroeconomic stability by keeping fiscal and current account deficits within the manageable limits. What is your view about it?
Well, actually, I've just recently written a note on the twin deficits. And the striking thing about the twin deficits is that they're both actually improving.
So I would request you to please tilt your phone because the image is inverted.
Okay.
Yes, you can proceed now, sir.
Okay. So, so the on the fiscal, let me just quickly start with the fiscal side.
Right, sir.
The last 4 months have seen a sharp increase in corporate and personal income tax revenues to the government. They have, personal income tax revenue and corporate tax revenues have sharply outperformed the revised estimates for fiscal year 22, and they have continued to grow very strongly in the first 2 months of FY23. So I can say very clearly that India's fiscal deficit in the current fiscal year, FY23, will be lower than 6% of GDP. The official target is 6.4. It'll be lower than 6. If nominal GDP grows 15%, as I expect, rather than 11% as the government projects, then the fiscal deficit this year will be less than 5% of GDP. Now, year to date, we've now got data for net market borrowing by the government, that is both the central and state government, in the first quarter of the fiscal year. Actually, until 1st of July, 2022. And over that period, the net market borrowing by central and state governments together is down to 2.4% year on year. It's down lower than last year. So that means that the government is already on track to bring the fiscal deficit down. And the main reason why that is happening is because of very strong revenue growth. Both those two items that I talked about, as well as GST revenues, continue to outperform expectations. That's one aspect. Second aspect that I need to also highlight is the fact that one item of revenue, non-tax revenue, actually was down sharply this year, and that is the RBI's dividend to the government. The RBI's dividend to the government is usually paid in May, and this year was down 67% on last year. So, despite the sharp decline in that single item, which is already done for the year, net market borrowing by the government year to date is down year on year. So as we go forward, as revenue continues to strengthen, and if we get the 5G spectrum auction actually happening, and if we see more privatizations, which seems likely, then you're going to get a substantially lower fiscal deficit this year than was officially projected. It'll be much lower than 6.4% of GDP, and that will in fact help to crowd in private investment in the current fiscal year. In fact, if you look at bank lending had decelerated for the last 7 or 8 years. It has started to turn up. Bank lending had accelerated to 11.1% growth at the end of May. At the end of June, it reached 13.2%. So we're seeing a steady acceleration in bank credit, which is a sign of a turnaround in fixed investment spending. So the situation is getting better on that front. And it's getting better, in my view, because the government's market borrowing is declining, and that is helping to crowd in private investment, as evident in additional bank lending to the private sector. Now, that's one of the twins. The other twin, current account. The current account deficit for the fiscal year was only 1.2% of GDP in FY22. There's a lot of loose talk in India about the current account. I saw newspaper reports where somebody is blithely saying current account deficit is 1.9% of GDP. I mean, for God's sake, please look at the numbers before you speak. It is not 1.9, it is 1.2% of GDP. And even in the last fiscal year, in the last quarter of the fiscal year, it was 1.5% of GDP. So the current quarter, the one that is just over, April to June, the current account deficit is going to be a little bit wider because it is seasonally the weakest quarter. But seasonally, the best quarter for both the deficits is the January to March quarter. So when we get to January to March 2023, we'll get a much improved fiscal and a much improved current account, helped by much lower oil prices. Oil prices are already beginning to moderate, but I think a really sustained moderation in oil price will occur after October as the global economy slows down, as demand therefore slows, and as you begin to see some improvement in supplies of shale oil. So it's a pretty good environment overall. I think neither of the twin deficits is going to be all that large. For the fiscal year 23, I expect that the current account deficit will be 1.5% of GDP. The fiscal deficit will be around 5% of GDP. And so both will be, one will be only slightly larger than the last fiscal year, that is the current account. The fiscal will actually be a lot lower. So we don't have a twin deficit problem.
So what is the kind of effect this, as you said, that this war is not going to end anytime soon. So what is the kind of effect that you see on the energy markets? You just said that you expect crude oil prices to cool off as we move towards 2023. So what makes you to believe that? Because on the one hand, we said that the war is going to be there. Russia is facing issues as far as our oil supplies are concerned. You spoke about shale gas coming into picture, and So what is the overall picture that the energy market is going to see in, say, next 6 to 7 months?
Well, first of all, Russian oil hasn't vanished from global markets. It's important to understand that Western Europe has been talking about banning imports, but they haven't yet. They haven't yet banned imports. They are trying to reduce their imports, but they haven't been able to ban. The US has banned imports of oil from Russia, but the US wasn't was not a very big market. It took less than 2% of Russian exports. So that'll have a marginal impact. Now, it's quite interesting that there was a recent report that Saudi Arabia's imports of fuel oil from Russia have doubled in April to June this year relative to last year. Doubled. They've gone 100% increase. You might want to know, why should the world's largest exporter of oil be importing oil from Russia? The world's largest exporter, the world's largest surplus producer of oil, swing producer in the world, is importing oil from Russia and doubling its imports. So there's something going on. And so Russian oil has not left the world market. Saudi Arabia never signed up for these sanctions, nor did India, nor did China, or Iran. So there are outlets for Russian oil. That's A. B, the fact that Brent crude is above $60 a barrel for 17 months now means that shale oil is becoming more and more attractive, and rig counts are beginning to pick up. So I think that sometime over the next 2 or 3 months, we'll see a significant increase in shale. Now, with shale, increased output is something that occurs with a bit of a surprise, because the amount of investment required for each oil field, oil well, is extremely high. But once the investment has been made, the oil must be quickly taken out. More than 60% of the oil is extracted within the first 12 months after the investment is made, and almost all of it is taken out within 18 months. So it's a high capital turnover business, but one that can bring surprises. So I think that now that we've had a prolonged period of high oil prices, it's only a matter of time before shale begins to really pick up. So that is one reason. And the second reason why oil prices are likely to come off is because the European economy is slowing. Places like Italy and Greece are paying much higher interest rates. Germany is shooting itself in the foot by importing less oil and gas from Russia. And so all of this, they basically are slowing the economy down. And since the economy is being slowed down, the demand for oil will moderate. And that moderation in oil demand from the huge European Union, to some degree also from the US, as its economy begins to lose some steam by the end of the year, will cause oil prices to decline.
So do you see supply chain concerns easing off? Because now we are seeing, unlocking in China happening. China is slowly moving towards normalization, but the state of economy of China is really very bad. But other countries are now normalizing. We had issues about war, which now seems to be a regional issue, more of a regional issue than really impacting the countries globally, except for the crude oil prices that we spoke about. So do you see supply chain concerns easing as we move forward?
Yeah, I think supply chain concerns will gradually ease off, but it's not going to be mainly because of China, because China, major economic centers such as Shanghai, Guangdong, Shenzhen, etc., have returned to near normalcy. But there are other outbreaks occurring in other parts of China. And so China is not out of the woods. Also, I think it's interesting to note that total social financing, the broadest measure of credit in the Chinese system, including off-balance sheet lending by banks, is up very sharply in the last 2 months. So China has been doing all it can to boost its economy. Despite that, real GDP in the second quarter was up only 0.4%. So I think China is facing serious long-term challenges. And the long-term challenges are focused in two areas. One is real estate, where the developers are in very serious financial trouble. The biggest developer, of course, has defaulted on its foreign currency debt. It hasn't yet defaulted onshore, but there are also serious problems with China's banking system. Most of the banks in one province, Henan, have more or less gone bankrupt. I mean, there's been a massive run on the banks in Henan province. So we have a serious financial sector proto-crisis in China. So what will have to happen is that supply chains that were focused on China are having to rapidly shift to other locations. Vietnam and India are two of the favorite places that are seeing the new investment. And so that will continue. But supply chain disruptions will not go away immediately. Now, that's one side. The other side is that China has had a massive investment boom over the last 25 years, and the rest of the world has had an investment drought. I think the two are linked. China has been over-investing like crazy. The rest of the world has seen very little investment spending. And I can illustrate that by looking at steel. So in the year 2000, China produced 128 million tons of steel. World production that year was 840 million. So the rest of the world, other than China, was producing 712 million tons that year. In 2021, China produced 1,053 million tons. So 128, so eightfold increase, more than an eightfold increase in China. World production was 1,950 million tons. So world production had increased had gone from 712 to 915 million tons. Rest of the world over 20 years had seen a very modest increase. And China had seen an eightfold increase. So that is the nature of it. If you look at investment spending, China's investment in the year 2021 is up 1,700% on 1996, on 25 years ago. If you look at the United States, Singapore, Indonesia, three very different economies, those three together have seen a CAGR, compound annual growth rate over 25 years of just about 3% each. So that's what I call the investment drought in the rest of the world, including a middle income developing country like Indonesia. Now, India is a little bit better. CAGR for India over the 25 years, investment spending is 8%. So not a total disaster, but very, very much slower than China. So now, interestingly, if you look at, say, steel, India is now the world's second biggest producer. The second biggest producer last year produced 118 million tons. So India is getting close to where China was in the year 2000. But China is 8 times that. In fact, it's 9 times India's, nearly 9 times India's annual production. India is the second biggest producer of aluminium. China produces 10 times as much aluminium as India. 10 times as much as the second biggest producer in the world. Now, cement is a little different because cement is not so easy to transport by sea. And so, interestingly, over the last 6 years or so, China's cement production has stagnated. It's not increasing anymore. But it is still this last year was probably going to be the last year in which China accounts for half of world cement production also. For the last 8 years, China accounted for more than half of world cement production. This year, we'll probably see China's share of world cement production probably decline to slightly below half. But, the point is that China has been monopolizing capacity expansion in all these industries. And not just these. If you look at photovoltaic cells for solar panels, China produced 70% of them worldwide. 70%. It's becoming a situation where the rest of the world has an investment drought and China keeps expanding. Now, the reason why China was able to do this is because China's banks were actually bust 19 years ago in 2003. In June 2003, Standard & Poor's, the rating agency, published a report saying that China's NPLs were at 50%. 50%. If your NPLs are at 15 to 20%, your banking system is bust. Typically, all the capital gets wiped out. If you're at 50%, then you are beyond bust. There's no banking system then. So what did China do? It took 45% of all its loans off banks' books at face value, just removed them. Then they got savvy investors to invest in Chinese banks, and like Goldman Sachs, UBS, HSBC, Temasek of Singapore, they all bought strategic stakes in the banks. Then they were listed on the stock market. So public investors from around the world helped recapitalize the Chinese banks, and they kept lending as if there's no tomorrow. As a consequence, what we now have is a really serious financial crisis, I think, that is emerging in China. And over the course of the next couple of years, they'll have to deal with it. Now, if the crisis actually strikes, then in some ways it's good for the rest of the world, because then China will be focused on its domestic problems, will not be expanding capacity without taking any account of the profitability of new investments. And as a result, we'll begin to see a capex cycle reemerge, investment cycle reemerge in the rest of the world, led by India. And so that is, in fact, increasingly that is becoming my base case, that we'll see an investment recovery occur in India, of course. In any case, in India, it's going to happen because the Indian corporates are in good shape. They've deleveraged. Banks are therefore keen to lend to them. And you're going to see a capex recovery in India. But that could lead a global capex recovery. And if that happens, then this recession should be relatively short-lived for the US and Europe.
If that is the case, sir, then where do you see Indian stock markets going?
Well, near term, I think the stock markets are still perhaps a little bit overvalued in the sense that the trailing PE ratio for the market is has now come down to about 21 times. 21 times is slightly below the average of the last 10 years. The average of the last 10 years is nearly 22 times, about 21.8 times. So we are below the 10-year mean. We're slightly above the 20-year mean. 20-year mean is even lower. It's closer to 20 times. But interestingly, if you take the 30-year mean, then the 30-year mean is more like 25 times, because India had its period of real overvaluation of equities, courtesy the great Harshad Mehta. Harshad Mehta, the so-called big bull of the early 1990s, caused that first overvaluation. And it was, so at that time, 30, 40 times earnings was in place for about a year or two. So, so if you look at a broad valuation scheme over 30 years, then right now, the market is perhaps fairly valued. But bond yields are higher than the equity earnings yield. And so I'd say that between now and August, September, we'll see a mild further decline in markets, in the equity market. But the good news is that the reason why the valuations are looking better and better is partly because markets have come down, but the stock prices have come down. But even more important is that the earnings have held up very well. In fact, have actually grown quite strongly in the past 15 months. Mm-hmm. And with that strength in earnings, you're seeing the trading PEs improve. So I'd say that equities will have another leg down, but fourth quarter this year and beyond, we should see the beginnings of a rally.
Mm-hmm. The market has been happy because we have FIIs turning positive from last 3 sessions. And we saw Nifty really breaching 16,600 levels, 700 levels today in the markets. But one last question, Mr. Basu, which are the sectors that you think would be, a growth drivers for India going forward? I mean, say next 12 to 15, 20, next year or two. Yeah.
Well, as I've said, we'll have good growth in the exporters initially. Export growth is still the main driver for India's recovery at the moment. So the exporters that are doing well are areas like steel and automobiles. Now, interestingly, those are areas that often do well when domestic demand is strong, when capex is picking up, or when consumption is picking up. So I'd say those are 2 areas that look quite good to me. I would currently have a relatively defensive portfolio, looking at cash-rich companies, those that pay dividends, that basically give you better yield. But in the course of the next 3, 4, 5 months, I would gradually move into a more aggressive portfolio where the cyclicals would be driving. And in particular, I think that we'll begin to see an industrial recovery gain momentum that'll be not just focused on exports, but more broad-based with the domestic sector also kicking in. And of course, within that, given that we're looking at a capex recovery in India, the capital goods sector should be one that does quite well. And eventually, consumer cyclicals will do better, perhaps later in the cycle, in the January to March quarter and beyond, by which point we should begin to see a more broad-based recovery in consumption, not only from the urban consumer, but also spreading to the rural, because we're likely to see a pretty decent Rabi crop. So as the Rabi crop comes in November, we'll begin to see improved farm incomes, which typically will help to improve the rural consumption pattern. The greatest hope of all is that the production-linked incentive scheme and the labor market reforms, if those jointly help us to see a significant boost in investment spending in the labor-intensive manufacturing sectors, then I think we could really begin to see a sharp, broad-based increase in employment across the economy. And when that happens, consumption will really get a significant leg up. But so far, I'm looking out for that. I mean, that to me would be the most bullish sign. So far, no real evidence of even a single really large project in labor-intensive manufacturing. There are small ones, but nothing of the magnitude that one wants to see, given the propitious labor market that has been created with the labor reforms.
Thank you, Mr. Basu, for being with us. I appreciate your time. Thank you so much.
Thanks a lot, Gitu.